I will have to start again. So thank you for joining me today. This is Janko speaking, and as per the request of some traders and attendees and clients, I will review some of the trading strategies that we reviewed previously in our previous webinars. The COP, which is the center of price, and the gold scalper, and some price action, support and resistance lines. So we'll review all these, and in addition, I'll show you some nice trades I took this week, some nice setups, and maybe we'll see some possible setups for the remaining trading days for this week. So again, let me start now that you can hear me. Let me start again with the S&P, with the center of price. I remind you the COP system, with the center of price, is made for the S&P or for other indices and commodities, but also for other trading instruments like currency pairs. For 1 hour, it's good for 1 hour, or for 4 hours. You can even take a look at the 15-minute charts, but it's basically for the 1 hour chart. Again, just to show you what I showed you earlier, but with no sound, now you can hear me. What I said, what I mentioned before, is that the S&P has this shoulder line. Okay, you can either stretch this trend line or this shoulder line of the reversed head and shoulders. You can stretch it either between these two peaks or maybe on this peak, and you can see that it gave us some nice resistance areas here and here and here. And yesterday it breached this neckline, but eventually closed just below it. So, and now it looks like this neckline may again serve as resistance. So it's interesting to see whether the head and shoulders pattern will eventually prove itself, and we'll see the S&P moving much up, okay, much further up, or this pattern will eventually be a false pattern, and perhaps the S&P will continue downwards. But again, this is not what I wanted to show you. I obviously wanted to show you the system, the center of price trading system. And the system, I remind you, is it's a trading strategy that uses two moving averages, which are like the home base or the center line, the center of price. Two moving averages, 75 linear weighted low, okay, and 85 linear weighted low. Okay, so these are the two moving averages. You can of course always try to change them, or try to change the application to close or high or median or whatever, and see how it affects the trading strategy. But this is basically the default setup. And the 75 line also has 4 levels up and 4 levels down. Okay, and these levels are Fibonacci numbers, and you can always try to change these levels. If you work with 4 or 5 digits, you may need to remove or add 0 to these levels. Okay, but we have 4 levels here. We have the 55, the 89, the 144, and 233. Again, here we have 0 on all of them because of the because it's the S&P, and it's 2 or 4 digits. If you see these lines too far away or too close to the center moving averages, just add or remove a 0. Okay, just play with it. You're basically supposed to see these levels wrapping most of the price. Okay, so again, 55 or 550, 89, 144, 233. These are Fibonacci numbers, and to the other direction, minus minus 55, minus 89, minus 144, minus 233. All these give you these levels. Now, basically, this trading strategy also has this moving average, the 5 exponential close, just a regular exponential moving average, 5. And the trading strategy on the 1-hour chart says that when the price and the moving average, the 5 moving average, are above the home base or the central moving averages, it's a long signal. And when the price and the moving average crosses below the central moving averages, it's a short signal. Now, the levels themselves also give us additional support and resistance levels. And the central moving averages can also obviously serve as support and resistance. So you can see here many times how the price found support around these central moving averages, especially when the 5 moving average also comes near the moving average, the central moving averages. The system is obviously good for trends. So when the levels and when the moving averages go sideways, when there's no separation, clear angle, upward angle or downward angle of the central moving averages, the home base, okay, when you don't have clear separation and good angle, do not trade. Okay, the market is going sideways. So these areas where you see the market going, where you see these moving averages like form a spaghetti zone, okay, or this bundling together or converging, do not trade. Okay, look for these areas where you see clear angle of the levels of the moving averages and where you see clear separation. Okay, the clearer the separation and the larger the separation, the better the trend is, or the stronger the trend is. And of course, you need a clear angle of the green line, okay, of the 5 moving average. That means the trend is going upwards. So here, this area is a good area to look for a long signal. Okay, we know it's an uptrend. You can see here the moving averages as an uptrend with clear separation, good angle. The price finds support here. You can see these reversal candles here, and you can look for a long position here. Okay, here a clear crossing of the price or the 5 moving average, the crossing of the central moving averages. Okay, and again, either you wait for support area or for a reversal before you take long, or you just enter after you find a clear crossing of the moving averages. So, for example, you can look at it as a channel, okay, and once this channel, you can see here, once this channel is breached, okay, and the 5 moving average now serves as support for the price, okay, this area could be a good area to start taking long. Okay, we have a clear crossing, we have a crossing of this resistance area. Okay, we have here this gap, it was support, resistance, resistance, resistance. Now it's breached. This trading channel is also breached, and this area here, if you didn't take it before, then this area here could be an entry point, a good entry point, especially now that the 5 moving average serves as good support. Now, when you trade, okay, and I showed you that in one of the previous seminars, when you trade the system, these levels, these Fibonacci levels, can also give you good areas for support or resistance. if you look to scale in or scale out. Okay, if you want to take additional positions, or if you think the trend is good and you want to enter with more positions, then these these support or resistance levels can give you good areas to enter. For example, okay, we have here this downtrend. Okay, this whole area is the downtrend, and we can see here this clear. You know what? Never mind it. We can see here this clear downtrend. We see here the price reaching some support. Okay, converging, and here, around here, it's forming sort of a triangle. Okay, and around here it breaks the triangle, and you can see here how these levels also serve as resistance. So we can see here convergence, resistance of this level, and a break of the price, continuation of the price. Again, we can see around here resistance. We can see around here resistance, resistance, and here a little bit of support and support. And again, so obviously it's not something you can try you can count on, and you cannot know for sure which level will stop the price, or will hold the price, or will be the last resistance or the last support. But just like I always tell you, if you find an accordance or a confluence of several indicators together, okay, or for example, support or resistance lines, trend lines, divergences that come together with these areas, then it gives you a stronger signal. Okay, so for example, here we can see here this area of support. Okay, we have support here and support here, and again support here. Okay, and this area you can also see this Fibonacci level here, the 144 Fibonacci level, that can also give you a good good indication that if you're already in a downtrend and you see these reversal lines, you know this is support, you know you have here support from the Fibonacci level, then maybe it's time to scale out or close the position or move your stop loss much closer up. Or for example here, okay, let's see, let's take this example here, more or less. Okay, so we have here, we see support around here, and the price is going down, and you see how it found support around this level, the 89 Fibonacci level. Okay, and again, okay, this area here along the trend line, we can see support around this Fibonacci level. So when you have several support areas together with the Fibonacci levels, when you have or resistance areas, okay, then this is where you should consider scaling in or scaling out, moving your stop losses, etc. Okay, again, you can see here trend line, you can see for example here there was support. Okay, you can see here this price action, small price action, but still there's some price action here of support. Price is breaking, coming, checking it again, testing it, and we have trend line, we have resistance line, and we have this level here. Look at the look at how the wicks here, the candle wicks here, really go along with the Fibonacci level. Okay, with the 55 Fibonacci level here. So these Fibonacci levels, again, they're not, you cannot count only on them, but they give you a good indication, especially if you see the price reacting around them here. Okay, and they can help you with taking decision or making decisions. Okay, so for example, if some of you, let's see, okay, no, there's no divergence here. I thought that maybe we could find a divergence here, and along with the support from this level, the 233 level, maybe the divergence would help us, but not, the Fibonacci is not giving us any divergence. Let's see if the MACD is giving us, no, the MACD also is, there's no divergence here. Okay, so you can see here the support from the last Fibonacci level, but there's actually no other indication of a possible reversal. Again, except for obviously these this reversal pattern here. Okay, this sort of hammer and this dark cloud, or this candle covering most of the previous candle. That's sort of a reversal candle and a reversal pattern along with this level. So this is the center of price. This is the system. We discussed it already a few weeks ago. For those of you who want to receive the indicators or the template, it's actually only a template because all it has is just 3 moving averages and the levels of the 75 moving average. It doesn't have anything else here, no other indicators. So if you want the template, or you can set it by yourselves, you can set it yourselves. 5 exponential close, that's the first moving average. The 2 other moving averages are 75 and 85 linear weighted low. Okay, so 75 and 85 linear weighted low, and the 75 moving average also has these levels. Okay, you can start with a 550 or 55. Okay, Fibonacci numbers 55, 89, 144, 233. Okay, and then the minus ones. Okay, the minus 550, minus 880 and 90, minus 144, minus 233. And again, if you see these lines, these levels, all too close to the center of price, to the moving averages, just add zeros to all of them. Okay, so this is the first trading strategy I wanted to show you, or that I was asked to show you or to review again. The second one was the gold scalper. Let's just take this one here, gold scalper. Okay, it's you can set it on any time frame, but the 15 minutes is a pretty good time frame. It uses, I remind you, it uses the smooth Heikin Ashi. Okay, Heikin Ashi smooth. I guess all of you by now know the Heikin Ashi candles. So the smooth Heikin Ashi is not only Heikin Ashi, which is a filtering type of candle. Okay, these candles, the Heikin Ashi candles, what they do is they filter out noises by averaging the price. Okay, so if the average of the recent price is, or the recent candles are rising candles or bullish candles, then the Heikin Ashi will give us blue candles, even if here and there we have some, you see some bearish candles. Okay, but the Heikin Ashi smooth does not only does it filter noises or filter candles that are not as the same candles as the trend. Okay, what it also does, the smooth Heikin Ashi, it behaves as a moving average by itself. Okay, so it looks like a moving average. It's smoothed out. It's smoothed, and it smooths the movement of the price. So you can see here that the price has many spikes up and down, but the Heikin Ashi candles themselves move very smoothly, almost like a spine. Okay, the smooth Heikin Ashi candles give us a general trend, a smooth trend, just like the moving average. It gives us the direction according to the colors and the strength or the momentum with the size of the candle body. Okay, if the candles, the body of the candles is big, the bigger the body and the smaller the wicks, the stronger the trend. Okay, so for example, here you can see a strong trend. Here it's a bit more choppy. You can see long wicks. Why long wicks? Because we have not only rising candles or bullish candles, we have also bearish candles. These bearish candles make longer wicks. But if this trend is stronger, okay, for example, here we have long bearish candles, then the stronger the trend, the smaller the wicks are, and they give us better indication of the trend. Okay, let's take a look a little bit backwards. So you can see here strong trend, and you can see here large bodies. You can see here very small Heikin Ashi candles because there's almost no trend. Okay, so the Heikin Ashi candles give us the trend, the momentum, the color gives us the direction, along with the direction of the candles themselves, and they give us support and resistance too. So you can see here, when the trend is strong, how the price, this is the close price, how the price found resistance around the Heikin Ashi candles. Okay, so when we have strong trend, in this case it's not strong, okay, it's just going sideways. But when we have strong trend and the price may find support along the Heikin Ashi candles. Here again you can see support, support, support. Okay, you can see here resistance, resistance. Okay, so when the trend is strong, if the price goes back to the area of the moving average or the Heikin Ashi, it may find support there. Now the gold scalper, and again you can try to use it, and you may use it for other currency pairs too, not only for commodities or not only for gold. It has the multi-time frame indicator here that shows us the general trend in several time frames, in multiple time frames. And what we obviously want is for an uptrend, we want the price to be above. Okay, for example, here we want the price to be above the Heikin Ashi. We want the Heikin Ashi to be blue, and we want the multi-time frames all to be in blue as well. Okay. On the other hand, or on the other direction, we will look for short trades when the Heikin Ashi is red, the price is below the Heikin Ashi, and the multi-time frames are the indicator is all red in all time frames. I remind you, the longest time frame, in this case the 4-hour time frame, is always the slowest. So it will always change color the last. Okay, or for example here they all turned blue, and here it changed to blue only after a couple of hours. Here they turned red, and the 4-hour chart took a few more hours until it turned red again. So for those of you who are more aggressive, you may look for opportunities to go short or long even before the 4-hour indicator changes its color. Obviously it's a bit more dangerous, or the risk is a bit higher, but you may sometimes take much larger moves here. Okay. Again, it's the 15-minute chart, so maybe the 4 hours just gives a general trend, but then again, if you just take, if you're just scalping, then waiting for 4 hours may not be always necessary. But if you do take trades, if you do open trades when all time frames and all indicators together are in accordance, then obviously your chances are higher. And again, don't try to trade when the price is crossing back and forth the Heikin Ashi, or when the Heikin Ashi is going sideways, when it has small body and long wicks. Okay, that's not good. So try to avoid trading unless you're really scalping and just taking a few pips. But again, when you see very small bodies, that's not a good indication for a strong trend. Okay, so and obviously you can always use support and resistance. Okay, you can always use support and resistance. So here, for example, we see resistance, resistance, and here this candle closes. Well, actually, the close is already much higher. So I guess waiting for waiting for a close here might be just too late. Okay, but you can see here already the Heikin Ashi, that you can see the price here. Okay, you can see the price here. The price closes above this resistance area, and all time frames are blue. The Heikin Ashi is blue, the price is above it, so I guess around here you can take long. It's also above, I would say the resistance is around here. This is the close price, so you can also you can already enter around here. Okay, this could give you a good area to enter, and from here it gives you about 70 pips. So this is the gold scalper, and let's take a look at this trading strategy with perhaps maybe the euro dollar. We can see here again on the 15-minute chart, the euro dollar, as you probably know, has been going during this morning. It's been going sideways. You can see the small Heikin Ashi candles. You can see here blue, red, and so there's no real direction here. But here, for example, you can see a nice uptrend, okay, or before that a nice downtrend. So again, you can see that the downtrend here, even if we wait for the price to break support, okay, yeah, there's support here, and then it broke the support. So even if you wait for the support to be broken and you decide, I have big Heikin Ashi candles here, big bodies, and all these indicators are already red, you can see that the 4-hour indicator is blue. Again, for those of you who feel comfortable enough and you know that this indicator is always lagging behind, you can look for the good trends or the good trades already here, okay, and not wait for the 4-hour indicator to be in accordance with the rest. Okay, now here again we can see how this uptrend started here, went down, and again. So if you just even wait for the resistance line or for the price to break, okay, we can see here the price breaking up and finding support around here, okay, and finding support, and we can see already the Heikin Ashi candles turning blue, and in this case all the indicators are all the indicators agree. They're all blue. The Heikin Ashi is blue. The price is above the Heikin Ashi. This is a good area to take to enter long, and we have here about 80 something pips. Okay, so that was a good uptrend. That was a nice movement, and with the system you can see how the indicators gave you a good signal to enter, and you see sometimes it's worth waiting for the price to break or breach, and for all indicators to go together. Okay. If you have any questions so far, please feel free to ask, and if not, for the remaining 20 minutes, we'll review again the last thing I was asked to review today: the support and resistance, or price action. So let's start with just a clear chart here. You know what? Let's take the euro dollar. Yeah. Okay. Let's just turn it to black, unless you prefer white, but the white may be too bright. So support and resistance and price action. What it means when you trade price action, you're looking for the price to react to support and resistance, especially with reversal candles. Okay, you're looking for areas where the price reacted before. When you look left, when you look at the chart to the left, you look for price reactions and price actions, and then when the price reaches or gets arrives closer to the area again, then you look for you look for entry again with reversal candles or other indications, like for example divergences and things like that. For example, okay, just a short example here. Okay, so we can see here this area. Okay, this area where there was strong reaction to this price level around here. Okay, we can see there's a strong reaction. We can see this bullish candle, very, very strong bullish candle, about 70 pips in 1 hour. We know that this area has strong support. I can even stretch this all the way here. Okay, so we can see these small candles, and then how the move started going up, and we'll see. By the way, we can see this this exact same movement. This is from the beginning of June, but I'll show you the same action yesterday, I think. Okay, I'll show it to you, the same price action. So we can see here these wicks and the price moving up, and then again reaction. Okay, here again we have this reversal candle. We have this strong support. We know it's a strong support, and reaction. Boom. Okay, going up again. Here too, it didn't really reach the price, maybe because there was also already expectation or pending orders before this area. Okay, but we can see this reversal candle here, this reversal pattern, and the price started moving up. And again, another wick here, another candle, and price moving up. Okay, so what you're looking for when you see price action is for areas where the price reacted strongly. Okay, and this can be just, for example, plain support or resistance, but it can also be reversal areas. So if you see, for example, this area. Okay, this area here where price served as resistance, even here. Okay, we have small support, resistance, gap. Okay, resistance, resistance, and when it's breached, we have support. This is where, especially if you see wicks, candle wicks here, and you see there's support here after it was resistance. This is the area where you can take action, and this is the price action. This is responding to the price action itself. You see no indicators, no moving averages, no multi-time frame indicators, no Heikin Ashi, nothing. Just plain simple support and resistance areas where you see the price reacting. And these areas are easy to trade, I mean, usually, because your stop losses are can be set close to the price, okay? And you don't even have to be tense. You don't have to hit the mouse or the order the minute the price arrives to this area. You can always wait for the price to first react. That's why it's called price action. You have to wait for the action. You have to wait for the reaction. Okay, so wait for an hour. Wait to see how the candle reacted. Maybe eventually this area will be broken. Okay, maybe this support line will be broken. Okay, you can never guess in advance, so you can always wait, and then you don't have to be tense. Okay, you don't have to be under pressure. Okay, when you enter and the price keeps going down a little bit or something like that, you can always wait to see the candle close around it, close around the price action area, and after that take reaction. Okay, even if you miss a few pips, okay, it doesn't matter. It's not so bad. And okay, and again, let me show you what happened, just like I showed you here. Okay, I showed you these small candles and then the price reaching this area and moving up with a strong movement. Let's see again something similar around here. Okay, again, we have here support area. You see these candles here with wicks, and from here the upward movement started. Okay, we see an upward movement, and once the price reached this area again, we can see long wicks, we can see strong movement. Okay, price action, and you see how it went up 150 pips from here. Okay, so this is price action, and you can always look for price action further up. You can see resistance, you can see the price trying to breach, and here this candle shows you it was strong resistance, but here the resistance was breached. The price now is sitting on this support area, which was resistance. It's finding support, and then you see boom. Okay, strong candles, 3 candles, and after that 2 more, showing us this strong support here. Okay, so price action can be very strong, and you don't have to run after the chart or run after the trades. Let them come to you. Let the charts show you where the action takes place. Okay, and even if you miss one move, you will always find another move. Okay, look at the strong reaction around here. You see these 2 wicks here. Okay, resistance, resistance, resistance. Okay, so we see here strong resistance. So this is price action, and there isn't much to tell about it. I mean, you can always look for methods of price action with certain candles or certain patterns. I find these sometimes a little bit complicated, or maybe not complicated, but you know, they define certain candles that are part of the price action patterns. Okay, I don't necessarily limit the price action to specific candles. Okay, what I look for is these wicks and the reaction of the price. It can be with dodgy candles, it can be just with regular wicks, it can be with long wicks and hammers. What's important is that you look for these areas to take action, okay? And you don't have to take action immediately. You can wait for the end of the candle, okay? For the candle to close, for the closing of the specific time frame you're working on, in order to take action. Okay, now obviously it's not always, it doesn't always give you good moves. It doesn't always work, and sometimes it can eventually reverse. Okay, so for example, let's say you took action here. Okay, you decided this is strong resistance. You see this wick going down. Okay, and it did give some nice move. Okay, like almost 50 pips, and you decide that after this candle you go short. Okay, maybe you thought, okay, it tried to breach and it closed below, and now I'm taking short. Maybe even there's a double top here, I don't know. But eventually it breached the resistance area and your trade is losing. Okay, so you lost a few pips, okay, let's say 10 to 20 pips. That's not too bad. And you can always set your stop loss above the, that's what I mentioned before. You can set your stop losses in not too far from where you opened the trades or where you entered, because these support and resistance areas are, you enter near the action, near the support or resistance area, and even if you have wicks, you can set your stop losses just beyond these wicks or candles. So even if you enter here, it doesn't go your way, you close out your trade with a small loss, or maybe you wait maybe to see if it does close above. Here it gives you another opportunity, but I would probably close my trade when I see this candle closing above it, or maybe I would even stopped out by the stop loss here. Again, that's not too far. It's only 20 pips, and then you have the option, the opportunity to go the other way around. Okay, especially if you're experienced traders, and if you're flexible. Okay, if you have a flexible mind and you say, okay, it didn't go well when I was trying to take short. Now it breached up, and now I'm taking long. Okay, so it gave you a nice opportunity here to take more than you lost, much more than you lost. I want to show you a trade I took here yesterday, exactly around this area here, around, I think it was around here somewhere. Let's see the 5-minute chart yesterday. Yeah, here. Okay, so it was this area where I took a short trade. And why did I take this here? So I saw this whole area of resistance. Okay, there was a strong resistance area around here. There was this reversal candle, this shooting star, and as some of you may know, I like the stochastic indicator. It gave a nice divergence. Okay, so although the price was going up, okay, the price was going up here. Here, the price formed bearish divergence. Okay, the peaks were going down. I saw this reversal candle on the 15-minute chart. I also saw not only, I mean, I saw this candle, but I saw again this resistance area around here, and I think I saw the MACD also some sort of a divergence. Yeah, a little bit. Okay, it was you can see here this divergence. Okay, so I saw this peak here lower on the MACD. I know that I I got the feeling that this momentum is weakening, and once I saw the 5-minute candle, okay, this reversal candle here, I decided to take short, and you see within 30 minutes or so it moved down more than 40 pips. Now unfortunately, and I must admit, I didn't take all the 40 pips because for some reason, where was it? Here, yeah. For some reason, I expected it to move a little bit lower because it did close below all these trend lines. Okay, I saw this. I thought it would move lower, but I should have paid attention because I was looking at the short time frame. I didn't notice or I missed the fact that this was, again, a strong support area. You can see it here. And that's price action. That's what I talked about. Okay, so we see the move up here and here. Okay, this is all price action. This is support area. I should have noticed that before, and I didn't. And now and I should have closed it here. I didn't. I closed it a little bit upward, a little bit higher, and instead of taking 40 pips, I took I think something like 20 pips or so. Okay, it's still it's not bad, but I'm you know, not every trade is perfect, but still it's nice to to see how things like reversal candles and divergences work. And obviously when you take other trades with price actions, then it's even nicer, okay, to see how the price reacts to these to previous price movements. So you don't have to trade the 1-minute chart or the 5-minute chart. You can easily find nice trades on the 1-hour chart. Okay, you can see here this price action around here. Okay, resistance. Okay, there was resistance here, breached around here. Okay, there was sort of a resistance again. Again, it's an area. It doesn't have to be exactly on the line. And you can see here again this small resistance, but eventually it was breached, and support. Okay, later on tonight, support. Okay, and I guess here it was just a trend line. So so you see there are some nice moves, and yeah, here it's about 30 pips in less than an hour. Just analyze the charts. You don't have to overload them with tons of indicators, although sometimes these trading systems and indicators are nice, but you don't have to overload them. And you can always just use simple lines, trend lines, support, resistance lines, price actions, and if you like, and if you see some divergences, they can help you too. Okay, for example, we see here higher highs and here lower highs and reversal candle. Okay, and you see here this downward move of about 50 pips. Okay, so just be patient. Let the chart give you the trades. Don't run after the trades. Let the chart, analyze it, of course, but just wait for these moments of clarity where you have this sort of epiphany or clairvoyance of what's going to happen. When you have this feeling, wow, I see here this area of price action. I see here the strong support or the strong resistance. I see here reversal of support and resistance. I see here reversal candle with divergence. I see here support from, I don't know, from this moving average or from a confluence of indicators. When you see these come together, Okay, and you have this feeling, okay, I may, there's a good setup here, then take the trade. Don't enter every other candle. Don't enter just because you're sitting in front of the graph or the chart and you think that, okay, let's enter because I'm already sitting here. Wait for these clear signals or for these nice areas where you can take safe, good trades. That's it. That's it for today. That's my advice. And if you have any questions, please feel free to ask. If not, then I think we'll call it a day, and I'll see you next week with more trading strategies, more technical analysis, and I don't know if next week we'll see Zulu Trade or MetaTrader 5 or whatever, but so thank you very much for attending, and thank you for your feedbacks. Thank you all, and I hope to see you again next week. So I wish you all good luck with the coming days. Be careful with the news coming up. It's the markets may be very, very volatile, and so just wait patiently for the right trades. So good luck, good trading, and thank you for attending. Goodbye.